We argue this time this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I think by going through 50, which is not technically important for us, but it is for anybody looking at it as a stupid price chart, it's, all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be.
Silver is once again drawing significant investor interest as it stages a notable technical breakout heading into the weekend. After struggling to break through the $37 level earlier in the week, the metal held strong support above $36. By Thursday, a renewed push brought prices back toward resistance, and follow-through buying on Friday propelled silver above $38 an ounce, marking a new phase of bullish momentum. MichaelOliver of Momentum Structural Analysis believes this breakout could be the beginning of a multi-month rally, projecting a sustained 4 to 6 month move similar to silver's explosive runs in 1979 and 2010. In those periods, silver spiked to $50, but Oliver argues that this time the rally could extend even further, potentially reaching $60 to $70 before any meaningful pause. Silver spent much of the year trading between $28 and $34, but interest surged in June as the metal climbed to $36. Since its April lows, silver has gained 34%, signaling renewed strength in the market. This resurgence has also impacted the gold-silver ratio, which has now dropped to 87.34, its lowest point since January, indicating silver is gaining faster than gold. Oliver points out that the previous $50 peaks in silver were extremely brief, lasting just a day or two, and when adjusted for real inflation, those price points would be closer to $300 in today's terms. From that perspective, silver still has considerable room to run. Analysts remain optimistic, citing robust industrial demand, increased investment flows, and persistent supply deficits as key tailwinds. With this combination of technical and fundamental strength, silver could be setting the stage for a sustained bull market. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It ran up last year in 2024, early in that year in March. We put out a major renewed buy signal on gold and silver and the miners. Renewed meaning that for prior couple of years, they've been in pause mode. Silver and the miners had been staircasing down in corrective mode. Gold was going sideways, basically, capped at around 2,000. We said back in March of a year ago that we're going to take off again. And sure enough, they did. Silver actually at one point in that rally outpaced gold pretty nicely, but it didn't last, okay, in terms of relative performance. Silver ran up in May of 2024, in other words, a handful of months after our signal, and got up it was at our time of our signal, it was $25, $26. It got up to $32.70 a year ago in May, okay, and dropped from there. Came up later in October, got to $35, new high. Gold was going sideways during that time. Dropped again, went back up in March of this year again to 35. And that's when they had that panic sell-off into April, where investors wrongly thought that if the stock market goes down, silver must go with it. Gold didn't drop much during that time, but silver was punished severely. We know that. Went from 35 to 27.50. Much of that in 2.5 days. Then it exploded right back over 30 and has worked its way up. Now we're at 37, either side of 37 for the last several weeks. That process in price where we basically, you could draw a line sideways from May of last year through a month ago. We've been above it and below it, but basically just violent oscillations. So it was really sideways. That was a corrective pause in price. And for momentum, our long-term momentum, it had a corrective pullback, where on the momentum chart, you could see a tube where momentum readings just kept zigzagging, but downside in this very clear technical tube, parallel channel. In June, early in last month, we crossed up through that momentum channel. Price wasn't making a new high, wasn't back above the 35 level. But in the 34s, momentum said, I'm out of here. Boom. Got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979 when silver exploded to 50. Also in 2010, the $25 to $30 level before silver exploded to 50 again. We argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It's like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at it as a stupid price chart, is all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be. Yeah, no, I don't think anymore. I think that occurred over the last year, as I explained, from May of last year up through June of this year. There was this momentum corrective process. And if you saw our charts, you would see what I was talking about. Momentum was revealing something that you couldn't see it on a price chart. On a price chart, you saw erratic behavior. It seemed to be trendless, yet net on balance, it was really sideways. Either side of about $32, up, down, up, down, up, down. Momentum was building a structure, what we call a structure, meaning a definable chart pattern, in this case, a perfect parallel channel that spanned an entire year when momentum was correcting from pretty high levels down to neutral levels. And then it said, okay, out of here. And it's out of here. So I suspect basically about every month going forward, we're going to see silver dramatically higher than the prior month. And I think we're not going to pause at 50. Anybody who's waiting to sell it up there again, I think is going to get bulldozed. But I think this is not a behavior pattern that's unusual for many markets, not just silver, where after a lengthy upside where there's been arm wrestling a lot of the way, up and down, confusing a lot of people. These things happen. That's reality. Markets ebb and flow. They have waves of profit taking. The question is, which one is real, meaning sustainable? None of them have been for silver. None of them have been for gold, sustainable on the downside. Even that collapse we had in April, which took it from 35 to 27.50, was back up in the 30s in a heartbeat and in new highs within a month. Okay, so you've got, if you're invested in silver, don't look at the day-to-day stuff. Even looking at price itself can be delusional, but at least look at the longer-term trend and you'll see what I'm talking about, that this arm wrestling process doesn't go on forever. And most bull markets, you get a point where you go whoosh, and people are shocked by the sudden change in the demeanor of the market. It's not what they expected because they've been trained by the market action prior to expect this continued doubt process, going up yet in doubt. And then suddenly there's a jolt, and if you're not there, you miss it. Because it won't give you opportunities to enter. As far as we're concerned, basically all the opportunities to enter are well below us. But you better get in soon because if we're correct, and I think we are, you're going to see this type of action, which will be surprising. And I bet it's correlated to certain other markets doing certain other things.
MichaelOliver emphasizes that momentum often shifts before price action does. In the case of silver, while the price was moving sideways in recent weeks, momentum was quietly building a base. Once momentum broke out, the price soon followed, delivering a clear signal that the market was preparing for a bigger move. Silver's recent breakout above $37.23 and $37.32 confirms strong bullish momentum. The 13-year high at $37.62 now serves as a key inflection point. With no immediate technical ceiling in place, the market appears to be gravitating toward the psychologically significant $40 level, provided momentum remains intact. On the downside, support is well defined, beginning at $36.16, then $35.28, with the 50-day moving average at $34.90 offering significant structural support. As with gold, silver's ability to stay above these key technical levels will influence how aggressively momentum traders continue to buy into strength. Oliver believes this setup is paving the way for the next significant wave in both gold and silver. He warns that the move won't be slow or steady. It's likely to be rapid and dramatic. Those not already positioned may find themselves chasing the rally, and that kind of panic buying tends to push prices even higher. In his view, that's the hallmark of how major bull markets typically climax, with a surge, not a fade. Let's get back to the interview.
First off, realize price is deceptive because the thing you're measuring by is a money unit, a fiat money unit, not backed by anything but BS. Whether it's the yen, the euro, dollar, they're all backed by nothing, okay? Government at the push of a button can increase its supply, artificially lower the cost of money, interest rates. And for the last 15 years, 10 of those years, we've had zero rates, free money. I mean, how hallucinogenic can you get, okay? And so it's a distorted yardstick. So if you're measuring something with a yardstick that is changing in real value year to year, especially every decade to decade, it's distorting the price reality. You're looking at price is not the thing you're looking at. It's the distortion in the money unit could be more of a factor than the actual asset you're looking at. Okay. Now, how do you factor that out? Well, you can't really because you measure it by a dollar, let's say. What we do is we take the momentum, meaning the dynamics of the underlying asset as measured by dollars. Many markets are dull. They're just going sideways. No momentum at all. They're just, up, down, trading range type thing. Strong markets or weak markets will often have sharply rising momentum dynamics or weak momentum dynamics. That factor, by using the momentum of the asset, even though it's somewhat distorted by the money unit, just like the price of the asset is, removes you a half a step away anyway from simply measuring by the money unit itself. You're letting one of the attributes of the asset do the talking. Okay. And when you plot momentum, meaning you oscillate the price action in relationship to a given moving average, let's say, long-term or short-term average, you'll get a different visual picture of that market quite often than you will when you look at the price chart. And almost all the time at a major top or a bottom, momentum will have warned you ahead of time clearly in a way that smacks you in the face if you had the opportunity to see a momentum chart at the right time. We don't use the wet noodle indicators. Those are the things like MACD and RSI, which are on everybody's screen for free, part of the package. Ours are more bar chart oriented, like you would look at a price chart, but they're momentum based. And again, we're looking for structure on the momentum, not whether it's just going up or down. You can have an up move in momentum that's not bullish. It's just an up and a down pattern. Okay. We look for structure, just like a price guy would. Is there a trend line? Is there a ceiling? Is there a floor? And if you're breaking it, because then momentum is saying, hey, I'm changing trend. And lo and behold, you look over at price and maybe it's not. Soon thereafter, it is. Okay. Price usually follows momentum. That's what we do. Factor, I'm sure, but again, it's a new factor. And don't assume that if the market goes down, it's because of tariffs. Markets always get stories after a top or during a top that only just then occurred. But the reason for a major bear market is almost always what occurred before that shouldn't have occurred. Some sort of excess. The dot-com bubble, for example. When the S&P went down 50% between the year 2000 and 2002, NASDAQ 100 went down 82%. Wow, it's a wipeout. And yet everything that they told us at the dot-com top about how good the internet was, what it was going to change our lives forever, was right. In fact, it was understated. And yet it still went down 82%. Why? It got overvalued too quick. This time we have multiple factors in play. The distortion in the money unit's been even more. That means money supply growth. Artificial rates for 15 years, way below what any market would have offered. So people made decisions based on free money. A bad decision. All of a sudden it's due. A lot of people are choking when T-bonds sit there. High yields stay there. They're choking on it. That's coming due. Watch commercial real estate, we argue. We've been arguing that for some time. Don't keep looking at NVIDIA. Yeah, it's going to top too. It looks like it's topping to us. The process. In fact, it's really gone nowhere for about 2 years, if you look at it. Year and a half anyway. It was over 140 back in 2024. It's 150 something now. Wow, big deal. It's been either side of that number. But anyway, these factors are coming into play now. And I think that's further dynamic underlying the upside in the monetary metals, which is going to hit with a jolt. No longer this, let's go step by step. All of a sudden, it's white knuckle flight, and people who aren't in it have to chase it. And that's quite typical in many bull markets at some point, usually later on. That's a real threat because it's too key of a market. It's bigger than the stock market, first off. Okay. It ain't getting better. Okay. You've had a drop in yields a year or so ago by the Fed, but rates, and then they rose rates. But T-bonds have basically stayed at high level of rates since 2022. Prices laid in the floor. It's tried to make a bottom. You could see it on a price chart. And we even thought on momentum you could get a decent rally, a counter trend rally, but one that would temporarily behave as an alternative to a doubtful stock market. Back in late last year and into early this year, it started to rally. It went from like the 114 level up to 121. This is long-term T-bond futures. Nice rally. When the stock market collapsed, it collapsed to 111 in a matter of about 2 days. When the T-bond market drops that much in a couple days, something's wrong. That's not normal behavior. And even though the Fed doesn't talk about it, they got to be really concerned about the illiquidity, the failure of that market to provide any help to anybody in terms of less choking rates. And therefore, it's a market to watch. But lately, it's been stuck in a range, so it's really not doing anything. But the thing it's not doing is recovering, dropping yields, raising the price of the bonds. That failure to rally is choking and choking and choking as each month goes by to debtors. And we think there's a potential here. We're trading in the 113s right now. You get back down to 110 again, there could be some kind of rapid implosion, something that creates headlines. So that this effort to base bonds, price-wise, yield-wise, to cap it is failing, and instead you spike lower in price, higher in yield. You can imagine the upset effect that will have on the stock market and the central bank. Beneficiary, monetary metals.
Quiet consolidation has given way to a striking surge as silver breaks through long-standing resistance levels with precision and strength. Backed by solid technical structure and escalating industrial demand, the metal appears to be transitioning from stealth accumulation to open acceleration. If the current trajectory holds, the rally may not just revisit old highs but rewrite them entirely. What begins as disciplined momentum can quickly turn into a runaway move once the broader market catches on. Is silver on the verge of becoming the standout asset of this cycle? And will latecomers fuel an even steeper ascent? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.